So we're talking about sensitivity analysis. And so, just like I was saying that you can buy a machine, that machine will be able to cost you some amount of money. Now, we are looking at how the profit will behave. How sensitive is the profit vis-a-vis other variables? So we look at the changes in the net present value, which we said yesterday that net present value is like the profit. If you increase the cost of that machine, will you gain something? If you increase the price of the product that you're selling, will you gain something? How sensitive is the profit vis-a-vis the cost of raw material, the cost of buying the machine, that is the initial cost, and even the cost, and even the price, unit price or quantity. So that means that ordinarily, when you want to look at profit, we normally say that profit is equal to the price minus a cost, that is variable cost, price minus variable cost times quantity minus the fixed cost. That is what profit is. Now, how sensitive is the profit when you vary the fixed cost? And fixed costs are things that you have to pay. They do not depend on the price. Like now, the amount that we pay our lecturers here, we pay them whether you're only 3 students or whether you are 100 students, we pay the same amount. Now, that is fixed cost. Now, that fixed cost does not depend on the number of students. So, how sensitive is it? Is the profit when we increase the teacher's salary, maybe from 2,000 per lesson to 2,500? How sensitive is it when we increase the price per unit? Right now, we are charging maybe something like 4,500. What if we increase it to 5,000? Or reduce it back to 4,000 and offer it? How will the profit behave? That is now what we call sensitivity analysis. We are trying to analyze the effective change on the profit, or what we call the net present value, as a result of the changes on these other variables. The variables are these. These are variables because they have an impact on the profit. So a change on these can bring a change on the profit. So it is the profit that is constant, right? But the variables can change. So the subject matter here is the profit, which now the result of this depends on these ones, the behavior. I hope that is good. Now, there are 2 ways of understanding the changes. The first one is called impact analysis. Under impact analysis, impact sensitivity analysis, we are looking at the percentage change. So we say, if I change the profits by 20%, what will be the change? If I change the price, either adversely, downwards, or positively, that is favorable, by 20%, what will be the impact on the profit? Whenever you're given the percentage change, listen, when you are given the percentage change, then that one now we call it the impact analysis. In some cases, the examiner might not give you the percentage change. If the examiner has not given you the percentage change, then that is called break-even sensitivity analysis. So we have 2 types of sensitivity analysis, right? Now, I want you to write something so that you can be able to remember and even understand what I'm saying better. You can say, right with me, that sensitivity analysis, and then you say that the focus in this case, remember this one is number 2. The first one under capital budgeting, yesterday we handled simulation, and today we are now looking at the sensitivity. You say that the focus in this case is to determine the effective on net present value. The effect on net present value. The focus in this case is to determine the effect on net present value. The focus in this case is to determine the effect on net present value. So net present value is like profit. So you're trying to look at the effect on profit. That is the effect on net present value due to a change in a given variable. due to a change in a given variable. So these are the variables. And whenever you're changing the variables, let the rest remain constant. You change variable one at a time. You don't change all of them at the same time. So if you are talking about the impact of fixed deposit change or fixed cost change on the profit, you let the other variables remain constant so that you vary them one at a time, right? When you look at the percentage change of profit, kindly let the other on the price, let the other variables remain constant. And so we are saying that it focuses on the determination of the effectiveness or effective or it is the focus in this case is to determine the effect on net present value due to a change in a given variable, holding other factors constant. Holding other factors constant. A change in a given variable, holding other factors constant. Holding other factors constant. Na kama umefika hapo na umeelewa, please let me know. Say proceed. If you want me to repeat, you can say. Sasa. So the change effect on NPV due to a change in a given variable, holding other factors constant. Holding other factors constant. Are we together? We can proceed. Sally, Faith, are you guys okay? So welcome, Mark. My name is CPA Dennis, and I like teaching AFM. So feel free, you can join us. We only charge 4,000 per unit. We can proceed. You can say that other factors remain constant, i.e., variables are changed one at a time. I.e., variables are changed one at a time. 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 One at a time. Fine. So that is quite good. You say that there are two types of sensitivity analysis. 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 Number A, impact analysis. There are two types of sensitivity analysis. Then you say A, impact analysis. Here you say that percentage of variance is given in advance. Percentage of variance is given in advance. Percentage of variance is given in advance. So that is what can help you to know. It is not easy to solve a question in FM when you don't know what they are asking. Like in this case, we are looking at the percentage change, but we are now looking at it under sensitivity analysis. So whenever the examiner has given you the percentage change, then that is called the impact analysis. Kama hujapewa, the examiner wants you to look at the sensitivity analysis, but you are not given this percentage change, then that is called break-even point sensitivity analysis. So that is number B. Break-even point sensitivity analysis. So in this one, you say that percentage of variation, the percentage of variation is not given. Percentage of variation is not given. Let me show you an example. We are not solving it, but I want to show you so that you can see. If you can really understand, if you are really understanding what I'm saying, I want to test. Who can share the past paper question? Nani ako na past paper questions? We look at 2019, I think November or something. So that you can understand the language. Who can share? AFM past paper questions. AFM past paper questions. So look at our WhatsApp. I've shared it on the WhatsApp group. I've shared it on WhatsApp group. Check our WhatsApp. Umeiona? Nobody has confirmed if you are seeing. Can somebody confirm that you are seeing them? Which year? 2019. 2019 November. I'm trying to share on the screen. That is what I'm doing. Let me see. I've seen question number B. I think now I have it, I can share. It's 2018, so we have 2019. May. You're seeing this one, number 1B. Can somebody read it for us? It's number 1B. You can read it. So the question says that Sunny Technologies is considering investing shillings 50 million in a new machine to manufacture computer microchips with an expected useful life of 5 years and no salvage value. It is expected that 20 million units of microchips will be sold each year at Kenya shillings 3 bob per unit. Variable production costs are expected to be 1.65 per unit, while incremental fixed cost will be 10 million per annum. The cost of capital is 12%. Evaluate the sensitivity of the project, net present value, to the following changes. So when there is a change in sales volume, when there is a change in sales price, and the variable cost, which kind of sensitivity is that? That is what I wanted you to test. You are not able to unmute. Oh, sorry. Let me unmute you guys so that you can talk. Just make sure that your background is clear. Okay. You can ask questions now. So which kind of sensitivity is that? Which type
impact?
Of, is it impact or break-even? Look at the question carefully, then tell me with a reason why you think it is impact or why you think it is break-even. Just go through it, then you can tell me the reason. That is what examiners do. They will set a question and then you start wondering. You know it is sensitivity because they are mentioned. Sometimes they don't even mention that it is sensitivity. It is you to know.
Okay, I thought it was impact because of the variable production cost, or it has to be in percentage.
So you are saying it is which one?
I said it was impact because
It is
of
impact.
we are given the variable production cost, or it has to be in percentage, the variance.
Yes, it has to be percentage. We say that the only way
Okay.
you know is under impact, you must be given the percentage of variance. You'll be told that when
Okay.
the sales volume varies by 20%,
Oh,
sasa
okay.
it's in percentage.
Mm.
Yes. Like this one now, they are silent. So if they are silent, that is now
It'll be
the
break even.
break even. Sasa.
Okay.
In impact, they have to tell you, they will tell you that the variable cost, this one has changed by 10%, adversely or
Okay.
favorably.
Mm.
Okay, now I want us now to look at impact analysis. We start with that. Now let's start by looking at the impact analysis. Impact sensitivity analysis. I want to say that it seeks to answer the question, it seeks to answer the question, what is the percentage change? It seeks to answer the question. It seeks to answer the question, what is the percentage change? What is the percentage change of NPV as a result of a given change in a key variable? What is the percentage change of NPV as a result of change in a key variable? So we say that it seeks to answer the question, what is the percentage change of NPV? What is the percentage change of NPV as a result of a given change in a key variable? What is the percentage change on NPV as a result of a given change in a key variable? So let's look at an illustration. So assuming that we have revenue, example, assume that we have revenue, and the revenue is revenue per annum is something like 10,000. Then we have cost per annum. Also, we have 6,000. Then we have the cost of capital, which we shall be writing as COC, is given as 10%. Then you are given the number of years. Number of years is 5 years. And then you have initial outlay. which we call IO, as 4,500. 4,500. Required. Determine the NPV of the project. 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 Determine NPV of the project. Number 2, carry out sensitivity analysis. Carry out sensitivity analysis. Carry out sensitivity analysis. If revenue and cost are varied adversely by 10%. Carry out sensitivity analysis. Carry out sensitivity analysis if revenue and cost are varied adversely by 10%. Now we say that NPV is normally like a profit. So let's have the solution. Let's have the solution. So we can make it look like a profit, and we say that profit is normally revenue minus cost, right? Profit is basically revenue minus cost. Profit is normally revenue minus cost. So what is the profit here? We have 10,000 minus cost, which is 6,000. We shall have our profit as 4,000. But we need to discount it, right? For NPV, we have to discount that profit. Profit is the cash flow. That is money that has come in. The amount that we normally discount must be the free cash flow. Therefore, our free cash flow is normally profit minus all expenses. All expenses. So this one is the same as profit before depreciation and tax, which is 4,000. In normal times, from this profit in your business, you took the total revenue that you got, that is the money that came in, minus cost, you get a profit. You need to deduct all expenses. One of them is depreciation, so you less depreciation, and then you tax. Now, listen carefully. We might find a situation like this, where you are given a depreciation of the machine. You know, the value of machine goes down with time because depreciation happens, and you are given tax. Where there is tax, then depreciation is relevant. Tunaelewana? Wakati umepewa tax, that the company uses corporate tax of 30%, then now you have to calculate depreciation kama umepewa depreciation. Or the best way to calculate depreciation, in fact, examiner will tell you that is on straight line. This is the cost of buying the machine, and the machine will stay for 5 years. So every year, it depreciates at a constant rate of 900. So depreciation is normally 4,500 all over 5. So that is the depreciation per annum. 4,500. That is the depreciation per annum. Now, if you are given percentage on tax, then it is important now to use depreciation or calculate depreciation. Why? Because depreciation is normally there to help us know the amount that is taxable. And then you add it back. So, listen, in case, this is where you are, profit before depreciation and tax, right? And then you are given that there is a tax rate of 30%. You want to look at the free cash flow so that you can know your NPV. 30% you need to calculate. The machine could have lived, it can live for 5 years without any residual value, meaning that at the end of 5 years, it is zero residue. You cannot resell it. So it will be totally depreciated. Therefore, you now come from here and say that less depreciation. I want you to write this somewhere for future reference. It will help you. Less depreciation, which is, let's say that is 900. So 900 according to this one can be 900. So if you less 900 from 4,000, what will be profit before tax? We have profit before tax because to share toward depreciation, so to be back in a tax. It will be 4,000 minus 900, and that gives you 3,100. Now less tax. I'm saying that this one is applicable where the examiner has given you the rate of depreciation or depreciation amount, or they have mentioned that depreciation is on state line. And the examiner has also given you tax. If there is no tax, don't worry. Without tax, you don't have to go through this. But if they give you tax, then you need to calculate from profit that you normally get, kawaida, you minus depreciation, then now less tax. Tax is 30% of this, so you say 30% of 3,100, and that will be how much? 93,930. Is it? $930. Now, when you less 930 from this, so it is 3,100 minus 930. What do you get? That will now then be the profit after tax. Profit after tax, which you call PAT. Profit after tax will be that. What is the figure? What will be the figure? Profit after tax?
2170.
2170. So this profit after tax, what we are looking at here, I want you to listen carefully and understand. When you are getting NPV, you are supposed to discount free cash flow, meaning that it is the cash flow after paying everything, including tax. So because we want that cash flow, we want it, we need to ask ourselves, now that we've been given tax, how much did we pay as tax? Tutoe pesa ya government iende, tubaki na pesa yetu. That is now what we call free cash flow. It is a free cash flow that is used to discount, that is used to calculate NPV. Sawa. So when you're given information, the first thing that should disturb your mind, from this information, how do I know the free cash flow? So because we have the profit, we can calculate. Then we know that now we've been told that there is tax. You now need to deduct that tax. And the only way you can deduct tax is after deducting depreciation. So unatoa hiyo depreciation kwanza to allow you now calculate tax. That's why we are saying that whenever tax is given, then depreciation is now relevant. If there is no tax, depreciation is irrelevant. Yani haijali. Haina haja calculate. Kwa sababu it is not going to help you calculate any tax. So depreciation is not actual money that has left. We are talking about flow of money, cash flow, pesa yenye imetoka. So depreciation is just an imaginary figure that we normally use, but it's not actual money that has left the account. So it helps us to calculate the tax, alafu tunalipa hiyo tax. Ile pesa tumebaki nayo after paying the tax, you add back depreciation because even though we deducted depreciation, there was no money that left our account. Tulitoa kwa sababu tunataka calculate tax, lakini ideally there is no money that left our account. So it is cash that is still there in the bank. We used it to calculate, tukapata 930 peke yake ndio tulitoa tukalipa serikali. But the balance remains. So how do I know the balance that is in the account? We add back the amount that we removed or we deducted at depreciation. So we say up to here, you now add back depreciation. You to do the actual money that you have in the account. That is now the free cash flow. It is cash flow that has not been spent. So add back. After getting profit after tax, now add back. Add back the depreciation that you took, the one that you actually deducted. So you add back depreciation, that is 930. No, 900. You add it to the 270. So that gives you, that now gives you the free cash flow, which is now 3070. That is now the cash flow that you can now use to calculate. Remember, when we're saying present value is normally the free cash flow times discounting factor. Now, this is now what we call free cash flow because haina baggage at all. We have deducted everything. We now remain the amount in the account. You can now discount it to get your NPV. Only when you are given the tax rate. If there is not, if you are given tax rate, that is when you now work with depreciation. If the examiner has not given you tax, it means that the full amount that we had here all went to our account. Hakuna pesa tulipoteza. Kwa hivyo kama hakuna tax, then the profit before depreciation is the same as the free cash flow. Profit before depreciation is similar to the free cash flow. Now, again, listen. Sometimes the examiner can tell you that it is the policy of the company to always set some money aside for future use. Maybe they want to have some development, what we call in finance or in accounting, capital reserve. Yani kuna pesa wanatenga kando ili ile machine ikizeeka wanaweza tumia hiyo pesa. So it is a rule. Ukipata pesa kwa account, they chop their money, they keep aside. So that amount you can be told that is the amount that they normally keep aside. If they tell you like that, then before you come to this free cash flow, deduct that amount. After calculating this, deduct that amount. Whatever will remain is now the free amount. Because if it is inside there, then we cannot assume that the whole amount is free. No, it is not all free. Part of it needs to be saved. Ndio watatumia kununua machine in the future. Are we together? So in this case, we don't have depreciation and we don't have tax in this particular example. So we are taking this as our free cash flow. They didn't even tell us that they are setting aside some money for future expansion. So the 4,000 is now our free cash flow because there is no depreciation and there is no tax. Depreciation is irrelevant if there is no tax. It is not making sense when there is no tax because it does not help you anyway. Okay, now I'm seeing some light there. I'm trying to work on it. Okay, I think now we are better. Okay. Now we can now proceed and calculate our, we are told determine the NPV of the project, determine the sensitivity of the, determine the NPV of the project. That was the first question, still. Now, how do you get NPV? NPV is equal to the free cash flow times discounting factor minus the IO, initial outlay. If you just say present value is just the free cash flow times the discounting factor. If you minus the initial outlay, then it becomes NPV. Usipotoa hii, it is just the present value, not net present value. It becomes net when you deduct this. So therefore, we can be able now to calculate that. So let's talk about our NPV now. NPV is equal to our free cash flow. We said that it is 4,000 times discounting factor. What is the discounting factor? This one, we are told that we are getting this revenue per annum, yearly. So that means that even profit is also yearly for the next 5 years. So every year we are getting profit or free cash flow of 4,000 for the next 5 years. Therefore, that makes it regular or irregular. Can somebody help me there? Is it regular or irregular? That cash flow. Somebody to help me there. Is it a regular cash flow or irregular? Sally, Faith, which kind of cash flow is that? Is it regular or irregular? Getting 4,000 every year for the next 5 years. Similar amount.
Regular.
Huh?
Regular.
Regular, good. And we say that this don't impact a formula for getting regular cash flow. I told you that don't forget about this formula. Regular cash flow. The formula is 1 minus into 1 plus r into negative n all over. The whole thing. You know, when I was young, I used to only divide this one like this. And that was a big mistake. That is how I used to get FM wrong. But when I realized that was a mistake, I've never gotten it wrong again. Take the whole thing all over R. That is the formula for regular. If it is irregular, it means that the cash flow keep on changing. Then use the normal formula where we have R, just like that. Just like that. Very simple. So this one is for irregular. Okay, so I hope you've written the formula somewhere. This one is about advanced level. If you are in intermediate level, please, or foundation or ATD, it might not help you. This one is advanced FM, advanced level, your CPA. So feel welcome, share the link with any student. Can you share the Zoom link with any students who is doing CPA or is thinking of doing CPA so that they can join? Sasa, tuma share kwa group zote, hata kama wanapiga kelele, we tuma tu, waambie waingie kama wako advanced level. Usiache jirani ateseke, si ndio? So let's look at that formula. So what we are saying is that now we have our 1 minus into 1 plus r negative n all over r. So this is similar to 1 minus 1 plus, what is r? R we're given as 12% or 10. Yes, we're given as 10%. So you write 0.1 into negative 5. The period is n. Yes, somebody is asking for my name. Liz, this one is advanced level. Advanced level. I think somebody has shared the link to your group. Let me show you the correct link. Okay, sorry for that. I've shared the link, the correct link, so that you can join. Liz, I've shared the link again for your class. You can join it. Class is going on the other side. So let's proceed. This one is advanced FM, advanced level. Maybe they shared the link by mistake. Now, we are saying now you can use this formula and now come here and say R. R is 0.1. So can somebody help me calculate this? Yesterday we agreed that you need to be a very good friend of your calculator. Must be part of your calculator every day because the speed matters. Speed is part of examination. So can somebody help me here? Calculate that. Somebody help me calculate that.
3.7.
So I have my calculator. Somebody has tried.
3.79.
3.79. Give me 4. We agree that with discounting factor, you have to give 4 decimal places. So give me the 4. 3.79.
3.790. 3.7908.
Good. Please remember that when you are calculating, always give 4 decimal places. It makes you become more accurate. So now we are there. So we can now proceed. And now say that NPV is equal to the free cash flow, which we said, times discounting factor, which now we know, minus IO. So we have our NPV there. 4,000 is the free cash flow times discounting factor, which is that. Somebody can calculate minus IO. IO we said is 4,500. Tell me what it is. We're getting 10, 6, 6, 3.2. So that is the NPV when there is no change. That is the initial NPV when there is no change. So now our question now, this particular NPV that we have, how will it behave if there is a change in any variable? The examiner has told us in Roman 2, so this one you have solved the first question, which was asking you to get the NPV. You are okay with that. The second question was saying carry out sensitivity analysis if the revenue and cost, they are very specific, revenue and cost are varied adversely by 10%. So what is the percentage of revenue if it is varied by 10%? What is the new percentage? If it is varied adversely by 10%, ukisikia kitu iko na adverse variation, is it a good one or a bad one?
Bad.
So if the revenue was initially 100%, it has varied adversely by 10%. So what is the new percentage?
90.
Yeah.
Is it 90 or?
Yes, be confident, you're right, 90%. So that means that the value of revenue that you were having initially has gone down by 10%. It is now 90% of that. But now, let's now look at this carefully. So let's look at the sensitivity analysis of revenue. Sensitivity analysis of revenue. We are now solving Roman number 2. Sensitivity analysis of revenue. So what happens is that we need to get our new revenue. So what is the new revenue? Because it is the revenue that has changed. New revenue is 6,000 was the original times 90% because 10% is gone. So our new revenue is, no, it was 10, right? It was
Revenue
10,000.
10. Yeah. Okay.
So then we have now 9,000. That is the new revenue. So what is the new NPV? New NPV. We need to calculate that. Everything remains constant. Remember, cost remain 6,000. Cost of capital remain 10%. 10%. The period remains 5%. Any other thing remain the same. We only change the revenue. So that means that our new profit. Are you seeing the step? New profit is now the revenue, which is now less, minus 6,000. The cost remains, and that will be 3,000. You are together? So from that point, we can say that now NPV, new NPV, this was the free cash flow, which is the profit. The other one was 4,000. Right now, this one is 3,000. So NPV is now 3,000 times discounting factor, which is 3.7908 minus IO, which is 4,500. What are you getting as the new NPV? After that percentage change, we are given a percentage change. So this is what makes it impact analysis. We have seen the percentage change on one of the variables, the other variables remain constant, and so we are able to calculate the new NPV.
$68.72.4.
Is that what we are all getting?
Yes.
So what are we doing here? We are now saying that there is a decrease in NPV. NPV has gone down. The initial NPV, we were having a higher figure. That was 10,000. But right now we are having 6,000. So it has gone down. That means that whenever revenues goes down by 10%, NPV also goes down. So that is how sensitive NPV is. So we want to ask ourselves, what is the percentage change in NPV if there is a change of 10% in revenue? Wakati revenue imepungua by 10%, what is the percentage change in NPV? So that is what we are trying to do, to calculate now. So we have seen that the new NPV is now this, minus all was 10. Can somebody read it? $1066.15 all over all. Come again. Times 100. Now we know that ideally it should be negative because we are having 6,000 minus 10. Don't put the sign, ignore the sign, kwa sababu we have mentioned that it is adverse. The fact that you have mentioned that it is adverse change means that whatever answer that you get here is negative. Sasa, there is a drop. So utapata hiyo adverse fine. So what are you getting?
Please.
30? Hey, not everybody is helping me here. Can we get everyone trying to help calculate? What is the percentage? Ignore the negative sign. Ignore the negative sign. Just give me the percentage change.
$35.55.
So it is 35.55%. We are saying that ignore the negative sign because above you have mentioned that it is adverse change. Kama umesema tu percentage change, then now that means that you can say adverse or put the negative sign. But once umesema hapa, ignore that. So we are saying ignore negative. Should be negative. Ignore negative. Adverse means that it is negative. Okay, so let's now look at another example that we are told to look at. That is the sensitivity analysis of cost. So tell me the steps. How do we start? One, look at the impact when there is a change in cost. So tell me the process. Where do we start from?
%90 of 6,000.
What percentage?
90.
90%. If cost varies adversely by 10%, is it increasing or it is going down? Bei ya vitu zikienda juu, inakuwa kitu mzuri ama mbaya?
Mzuri. Okay, able repeat the question 2. I think I wrote it wrongly.
Question number 2.
Of the cost. Yeah.
It is saying carry out sensitivity analysis of revenue and cost. So carry out sensitivity analysis if revenue and cost are varied adversely by 10%. If they are varied adversely by 10%. So if revenue varies adversely by 10%, is it increasing by 10% or going down by 10% revenue?
It's going down.
It is going down. What about cost?
Going going up.
When cost
It's going down.
it goes up or down? Huh? Cost is a bad thing. Ni kama accident, ikiongezeka hiyo ni adverse. Ndio, ikiongezeka. So ukisikia it has varied adversely by 10%, imeongezeka. Bei ya vitu zimepanda. That is what we are saying.
Yes.
So it has gone up by 10%. Ikipungua, that means that it is favorable because it is an expense to us. So if any cost goes down, that is favorable. Bei imekuwa poa. So we are saying that the new cost will be the 110%. It has gone up. That is why it is adverse. Times the original one, which was 6,000. We are having the new cost as 6,600. Revenue remains constant. So revenue is still 10, right? And the cost of capital, COC remains 10%. Same time, number of years is still 5 years. Therefore, we can say that now our new profit is 10,000 minus the cost, which is 66, and that gives you 34. That is the profit. Profit goes down that. We can now calculate our NPV, and we say that this profit is the same as the free cash flow because we don't have tax, we don't have depreciation. So they're the same. So therefore, we can calculate our new NPV. So the new NPV is equal to 34 times the discounting factor, which is 3.7908, minus IO. Initial outlay was 4,500. So what is your new NPV? As a result of a percentage change, 10% change in cost, what is the new NPV? I'm getting 8.
8388.72.
Sasa tunaelewa. Sally, we agree that if there is adverse change in cost, then that means that the cost has gone up. If it is favorable, then the cost goes down. It's the opposite of revenue. With revenue, it is income. So if income has got adverse change, then it means that it has gone down. If it is favorable, it goes up because it's a good thing. So this is the new NPV after the change, right? Now we can look at now the sensitivity analysis. So let's look at the variance. We say that we're having new minus all or over all, right? So percentage of variation, is it adverse? NPV has gone down, so it is adverse. So we say percentage of adverse variance or variation. So we're going to have 8388.72 minus, that is the all new, that was new, minus all. As I told you, so we start with new minus all. So the other one was 10, 6, 6, 3 point what? 15. All over 10,000, 6, 6, 3.15. This times 100. We say that you ignore the negative sign, because already you have mentioned here, it is adverse. So we know that that percentage change is not a good thing. You have mentioned it is adverse, and as you can see, NPV has gone down. So just give me the percentage, ignore the negative sign. No,
21.05.
I got 21.33. 329.
So it is 31. What are you getting? 21 or 31?
21.
21 point.
I got 21.33.
No, I'm not getting you well. 21 point. We agreed that we speak haraka haraka. 21 point. Ama nijifanyie.
20.33.
Thank you. Okay, so that is how it is done. That is how it is done. This is 100%. Let's now look at lesson number 2. Lesson 2. Illustration 2. Before we go to break-even analysis. We do illustration 2, then we take a break. So.
Yes.
Yes. Include an mass.
Clay is surely.
Is there any question on where we have covered?
I'm okay.
Sally, are you okay?
Yes.
So you can write down, there is a question here on December 2013. Say December 2013. December 2013. Question number 2. December 2013, question number 2A. December 2013, question number 2A. The question says that R Limited is considering a project with the following cash flow. R Limited is considering a project with the following cash flows. R Limited is considering a project with the following cash flows. R Limited is considering a project with the following cash flow. I've shared on WhatsApp. R Limited is considering a project with the following cash flows. Then we have year. So we have year. We have cost of plant. We have running cost. We have savings. In year zero, whenever you see something on year zero, that is initial cost, because in year zero, you cannot have, it is not possible to have spent some money. In running cost or operation cost, not possible. Year zero is the first time you are injecting money into the business. That money that you put in the business is called initial outlay. It is different from the normal operation cost or what we call running cost. Najua unaweza weka pesa kwa biashara and then baadaye kuna bills unalipa one, yeah? Unalipa maybe stima, unalipa rent, unalipa salaries. Those are now the running cost. But the initial cost that you inject in the business is normally on year zero. So the one that is on year zero is normally the cost of the plant, cost of the machine or the plant. So we have it here. Sometimes they put it negative. You might find that they are putting for you year zero, then they put it negative. That means that it's cash outlay, money that went out. So in that year zero, we didn't have running costs because we are just starting the business. And then we have one. Running cost in year one is 4,000. And then year two, 5,000. Then we have fellow, 1,000. We have 14,000. You are being told that R Limited's cost of capital unlimited cost of capital, unlimited cost of capital is 9%. Is 9%. Required, determine the sensitivity of the project to changes in the levels of plant, cost of plant, running cost, and savings. Determine the sensitivity of the project to changes in the levels of cost of plant, running cost, and savings, considering each factor at a time, and assuming that each factor is varied adversely by 10%. Which kind of sensitivity analysis is this? They are varied by 10%. That is December 2013, question number 2A. Which kind of sensitivity analysis is that?
Impact analysis.
impact analysis. So the first thing that you do, you start by looking at the all, or what you call base NPV. Just like the other one, we started by calculating the NPV without any change. NPV before any change. It is called base NPV. Sasa. Base NPV. That is NPV without any change. And then now we change one variable and we now check what is the new NPV after that change. We again change the second variable and check what is the new NPV after the change. So let's now get the original NPV. Determine the base NPV. That is the solution. Number one, determine the base NPV without any change. Whenever you're told to get sensitivity analysis, you need to ask yourself, what is the NPV before any change? So the base NPV, how do we get it? We say that normally NPV is normally the profit or the free cash flow discounted. We need to know the free cash flow and then we discount. So what is the original NPV for year one and year two? We take the cash flow. So we have year one, year zero, then one, then two. Year zero, one, then two. Then cash flow. In year zero, cash flow was money going out. That is cash outflow. So it is negative 10, or just say 10,000, but in bracket. In year one, we did some business. Our savings was 12, and the running cost was 4,000. So what is our profit in year two? In year two, the net cash flow, savings minus any cost, running cost is 8. So it is 12 minus 4, which is now 12 minus 4, which is now 8,000. That is the free cash flow. It's the same way in year two, we have, this is actually 5,000. So we have 14 minus 5. So we have 14 minus 5. So that we have 7. Is it 7? No, 9. Yeah. So 9. It is this one that we can now discount to get our NPV. These are the free cash flow. So it is the total cash flow minus the costs. So we can now look at discounting factor. Discounting factor here, when you look at the cash flow for year one and year two, they keep on changing. So are we using regular or irregular? Somebody to advise me.
Irregular.
What are we using? Pet.
Irregular.
Thank you. So irregular is 1 plus r negative n. So we're using that at, what is the percentage? 9% here. That is what the examiner has given. So we discount it at 9%. So in year one, year zero is normally 1. Anything raised to power negative 1, to power 0 is 1. Then now we can now count year one. Year one, we now calculate. So you have 1 plus 0.09 into negative 1. What are you getting?
.91.
Yeah.
0.9174.
Sauti iko chini. Sali, hebu ongea.
0.9174.
0.9174.
174.
Okay, the next one. Now change this to 2. What are you getting?
Zero point 8417.
Okay. So our NPV can get now here, or we can get the present value. Now NPV. NPV can now get. So this one is negative 10,000. Multiply 8 times 0.9174. What are you getting?
Seven three three 6.8.
When you add, what are you getting?
7339.2. Okay.
Fourteen 914.5.
14?
914.5.
Yes. Now you minus because it is now NPV. So you minus this 10. So you add all this. If you ignore this 10, this one, the initial outlay, then whatever you're going to get here, that 14 is called present value. So present value minus initial outlay becomes the net present value. So the answer is 4,914.5. Now that is what it is before. That is now the base NPV. We can now vary some items. Let's now vary them. They told us to vary what? Sensitivity analysis of cost of plant. Cost of plant. So we are changing cost of plant, leaving the rest constant. So cost of plant is gapi 10,000. If you vary it by 10%, then that means that it is going up or it is going down. Is it going up or down? When cost of plant has varied adversely by 10%, what is the new percentage?
110.
110. So what is the new cost of land? So we have 110 times the old one, 10,000. So the new one is 11,000. That is the new cost, right? So you replace here with 11,000. The new cost is 11,000. And so this one will also be 11,000. So what is the new? After variation of cost, the new one will be 3,900. Tumeelewana? We only change the cost, the rest remains constant, and you have that as the new one. So our percentage change, we say the formula was, is it adverse or it is favorable? The change there, is it adverse or favorable? Change on NPV. This one, is it adverse or favorable?
Adverse.
Huh?
Then the old was 4.49 and then the new one is 39. So it will be adverse.
Is the percentage favorable or adverse? NPV, hapa chini. NPV is a good thing, it should be profit. So profit ikienda chini, is it adverse or favorable?
Adverse.
That is what I wanted. So you say percentage of adverse change. Is equal to new NPV minus old NPV all over all NPV times 100. So that is 3914.5 minus the other one was 4915 or 14.5 all over 4915. What are you getting? Ignore the negative sign because you have said it is adverse. So it is what is the percentage change?
Twenty point 34. 5.
20 point?
20.35.
20.35%. Okay, so that one we have varied the cost of plant. Let's now vary another one. We are told that we can vary revenue or running cost. So running cost. So when we vary running cost, what is the new percentage of running cost? Running cost is also a cost. So the new percentage, the
110.
original running cost was in year one, it was 4,000. Year two, it was 5. Sindio? Sindio?
Yes.
Yes.
So if it was 4,000, like now in year one, it was 4,000. The new running cost becomes new running cost year one, new running cost
Is it 4,400?
becomes 4,000 times 110.
110.
So that is
44.
4,400. Sindio?
Yes. Yes.
For year two, also we have 5,000 times 110%. That becomes 5,500. So therefore we are having this one 5,500, 4,400 here. Here also 5.5, which is the same as 5,500. So 12,000 minus 4,400 unapata ngapi? Sindio, 7,600. I believe that is the new one. Then the new cost here is 14,000 minus 5,500, which is this. Unabaki na 8,500. Sindio? Now those the two become the new profit or cash flows. So if they are the new cash flows, you can now calculate. So this one remains constant. Initial outlay was 10, it remains constant as 10. Only these two have changed because that is where the running costs are affected. So you multiply and get the new NPV. This one remains 10. Our new NPV is so we have 7,600 times 0.9174.
6972.24.
Now what is the new NPV? Add them. That is what I'm getting. Confirm it is true. So our new is 41 and 4,126.69 minus the original was 49 14.5. 49 14.5 all over 49 14.5. The percentage change is I'm getting 16.3. Confirm that is that one.
Yeah,
And somebody can now try
16.3.
for us the new one, sensitivity analysis against revenue. Against revenue. So you need to get the new revenue. New revenue for year one. Year one revenue. Revenue for year one was 12. So if it is adversely affected, it means that it goes down by 10%. So we go to 12,000 times 90% because it has reduced by 10%. I think it is 108 something. Year two, we have 14,000 adverse. So 90% of this. 90% of 14. What are we getting? 12,600. Eh? So our new profit, year one and year two. So in year one, other things remain constant. We take 10,800 minus the old cost. The old cost, this is now the new revenue minus cost. Old cost was 4,000. Our new profit is 6,800. That is the cash flow, which we shall have here. And then here, we are having 12,600 minus 5,000. And that becomes 7,600. I hope that you're together. So therefore here, we shall come and replace again 6,800. This one is 7,600. Multiply and get the new NPV. So 0.9174 times 6,800. 62, 38.32, 0.8414 times 76. So we get 2,635.24. That is a new NPV. That is a new NPV. Now we can calculate our analysis, sensitivity analysis. How sensitive is it? By what percentage does the NPV change? So sensitivity analysis, we look at adverse change. This adverse because it has gone down, so adverse change or variance is equal to 26, 35. Once that we write new NPV minus all NPV, or lower all NPV. So we are having 26, 35.24 minus 4914.5 all over 4914.5. This one in percentage. In percentage, and you can get 46.38%. So that is the sensitivity analysis of revenue. That is the end of the first part of today's lesson. Do we still have the energy to proceed, or we take a break for today?
We take a break.
Then we come back. Ama we postpone. Let's take a
I
break.
thought you said tomorrow. Sorry.
Yes, let's take a break of 30 minutes and then we come back. Eh? So tuna meet sangapi?
I have a question.
Yes.
I saw in the timetable we have an advanced FR. Ama iko from 6. From
Are you
the
taking
timetable
advanced
I
FR?
saw. Yes.
You are in that class?
Even yeah, I'm in the group. I saw in the timetable.
Advanced FR iko.
Saa ngapi?
Advanced FR iko. From 6 to, it is there from 6, just a minute.
6 to 8. No.
6 to 8 p.m.
Yes.
Yeah, 6 to 8. But today the teacher communicated that he's not going to be in.
Oh, okay.
That is why this one is going on. Faith, are you on paid group?
Sorry?
Are you on the paid group? WhatsApp paid group?
Yeah, the one for FR and also the one for FM.
Uko kwa FR and FM? Oh, Faye.
Yes.
So that is why the class has not happened. So thanks so much. Let's take a break and come back from.
Dennis,
Uh-huh.
I don't think I'll make it for the next class.
Come again?
I'm heading home. I don't think I'll be able to attend the next class.
Or you'll not be in for the next one if we come back in the next 30 minutes.
Yes. Naenda home sahi natoka job.
Oh, no problem. Then what about if we start from 8?
I think from 8 is fine. I'll be home by then.
From 8?
I'll be home by then.
Okay, let's then come back at 8.
Okay.
So thanks so much.